The element known as fair value gap forms the foundation for several crucial strategies in technical analysis. It is observed when the middle candlestick of 3 consecutive candlesticks on the chart, named fair value gap, remains uncovered by the wicks of both candlesticks on either side, including the one in the middle. The colors of the 3 candlesticks within this concept are not significant. The gap seen in the middle candlestick's body, occurring in an empty space, results from a sudden drop or rise in price due to weakness in the order book in the stock market. Additionally, market makers are likely to exploit this gap in their favor, and the price is highly probable to fill that gap sooner or later. This filling movement attracts the attention of small investors who are knowledgeable in technical analysis, providing them an opportunity to increase their capital by capitalizing on the potential market movements. In addition, another region where price gap occurs is referred to as liquidity void, unlike fair value gap, which is located above and below order blocks. Liquidity void gaps can occur anywhere in the price movement. Both of these fair value gap formations are collectively called the imbalance zone. I will simplify the explanation of these formations as imbalance for your better understanding, and I will design the examples accordingly. This way, I believe you will engage in simpler and more successful trading transactions. Before we delve into examples, let's not forget to subscribe to the channel and like the videos. Let's get started right away. In our first example, we observe a rectangular region marked as FVG, which represents a gap area caused by an imbalance in the order book due to a sudden upward price spike. This gap region is likely to be revisited by the price as market makers would seek to fill this region again. The order book is expected to be filled with new orders, leading to a breakout either upwards or downwards. Since this gap region is formed after a downtrend, one might assume it could initiate a new uptrend. However, upon the price reaching this region, it is essential to observe whether a reversal pattern or a different turnaround formation emerges. It is crucial to note that placing market orders directly into this region can be a risky venture. As anticipated, the market maker initiated selling, bringing the price down to the bottom of the imbalanced region you see here. Since the imbalanced region was filled with price action, depending orders came into play, causing the price to create a pin bar and move upward. Please note that the move here wasn't very strong. Subsequently, a black candle formed, followed by a voluminous gray candle, creating a perfect engulfing candlestick pattern. With the formation of this pattern, a long position can now be entered from the closing level of the gray candlestick you see at the end. As you can see, while the price was filling the fair value gap region downward, it created another wide fair value gap region, marked with an orange rectangle. In the trade, we will open with a 1-to-2 risk-reward ratio. Our initial target will be the upper part of the orange rectangle region you see at the top. When the price reaches this level, adjusting the entry to the stop-loss level can enable the pursuit of a higher target, the FVG region, which we consider as a trigger to enter a long position, can also be utilized as a significant level for our stop-loss. As this region serves as the triggering area, we can position our stop-loss just below this area. As always, you may be expecting excellent results. However, this trade automatically closed upon reaching the stop-loss level. My friends, you know, as I've mentioned in many of our previous videos, despite my efforts to demonstrate how natural it is to profit in the market on this channel, I have also frequently emphasized that there will be trades resulting in losses. Don't think that this strategy won't be beneficial. Looking at the trade that closed at the current stop-loss level. Like any strategy, there will be trades where the stop-loss order works. However, this strategy is based on such a strong foundation that if you adhere to its rules with discipline, you can be sure to achieve a higher profit than the loss you incur. Because the foundation of this strategy is based on opening and closing trades according to the actions of the market maker that determine price movements in the markets. It is not possible to operate in the markets with a more realistic strategy than this. Now, let's look at a different trade example and reinforce this powerful strategy. Now, let's make 2 consecutive trades by following the price action. Indeed, when you carefully examine these trades, you may not need any other strategy when trading in the markets. If you have any questions about the consecutive 2 trades I'm about to demonstrate, please don't forget to mention them in the comments section. In the example you see on the screen, there is an order block at the top, and just below it, a black candle with a large body that formed due to a sudden drop in the market, caused by a gap in the order book, creating a fair value gap. This area appears to be a strong resistance zone. When we observe the combination of an order block and the subsequent fair value gap, we can understand that this area is a robust resistance zone. When we zoom out our chart a bit, we observe that the price is dipping below these zones. In such situations, to enter a trade, we need to carefully monitor important formations and indicators like reversals. Ultimately, we continue to track these opportunities because we anticipate that the price will likely reach the marked zones above. However, exercising patience will always safeguard our capital. When the price movement turned upwards again from the downward direction, it approached the trigger zones we consider as FVG and the order block at the same time. As you can see now, it made a visit to the FVG area with a wick. Now that we know this pin bar is a bearish candlestick, and it touched our trigger zone as a fair value gap, we can look for a short position below this area. However, it's crucial to see a reversal formation after the pin bar for our trade to be successful. Our expectation was met, as the price surpassed a bit above the orders formed at the previous peak, triggering the stops for those orders. Subsequently, with the formation of an engulfing candlestick pattern, the price reversed its direction downwards again. Now, without any concerns, we can enter into a short position. Even if our trade results in a loss, we may experience a small amount of loss. But it could be reasonable to accept this risk as our target is set at a considerably wide level. We open our position with the closing of the black candle, following the engulfing candle formation for our trade as a target. We can set our sights on a historically significant support level. Now, let's see how our trade will unfold. And as you can see, although the fair value gap has not been completely filled, we still achieved an excellent profit ratio. By accurately analyzing the downward formation we captured, we obtained a profit of approximately 1 to 4.5. When you capture formations like these, and they align with your criteria, you should consider evaluating the trade without hesitation. Hesitating won't lead to achieving a good profit ratio. So, after a successful trade, we took our profit and completely closed our position in the market, right? Certainly not. After the price dipped below our target, it turned upwards again, rising enough to create a level of character change. From here, it began forming higher lows. Once we mark the character change level, we need to confirm the upward trend by drawing an interim resistance level. If this interim resistance level is broken to the upside, entering a long position this time may provide another opportunity for significant profit. The upper target could be the previously entered and not completely filled fair value gap area. After all, the target zone can be extended up to the location of the order block, just above the fair value gap area. In this projection, I decided to push the profit target up to the order block. Now, let's see how the trade unfolds together. We executed a truly well-analyzed and excellent profit-yielding trade. As you can see, the price extended up to the order block above the fair value gap area, and we successfully took the entire profit we aimed for up to that point. Dear friends, let's conclude today's educational video here. Until our next video, goodbye for now.